Hello, and welcome to this annual update of the Baillie Gifford Japan Trust. My name is Matthew Brett, and I am the Trust Manager. As a reminder, the Japan Trust aims to deliver long-term capital growth through investment in companies which we believe have above-average prospects for growth, and mainly focuses on those of medium to small size. In this short update, I will talk about performance, portfolio changes, and the reasons we are excited about the future. Recent performance has been disappointing. Over the year to 31st of August 2023, the Baillie Gifford Japan Trust plc's net asset value total return per share was minus 5.4%, compared to the plus 6.7% total return of the Topics Index. In sterling terms. The sectors that are driving the growth in the market are traditional value sectors like cars, megabanks, and some industrial companies. These are areas where we have little exposure, as we believe these types of companies offer little fundamental opportunity for growth investors. The market backdrop has been unhelpful for the types of growth companies that we invest in. It is always difficult for us to assess when businesses will become better appreciated, which is why we try to focus more on the underlying progress of sales and profits, in the expectation that over the long term, these will be reflected in share prices. Like you, we would have preferred to see significantly better share price results over the past couple of years, but in general, we see solid ongoing progress at individual businesses and take significant comfort from that. Reflecting this operational progress, the board has decided to propose a final dividend of 10 pence per ordinary share. This represents an 11% increase on the 9 pence paid last year. Our focus has been on continuing to try and improve the portfolio. During the past year, we have bought 9 new holdings and sold 7. We have been able to take advantage of the high levels of pain being felt in smaller growth companies' share prices to initiate holdings in companies such as Vector, the public relations agency, SWCC Showa, which makes high voltage cables, Nihon M&A, which does mergers and acquisitions in Japan, and LifeNet, the online life insurer. The very large share price moves have exceeded the changes in company fundamentals, which we believe presents opportunities for long-term investors. The sales that we made spanned a variety of reasons, from considering the shares to be fully valued due to cyclical increases in resource prices, such was the case for Impex and Toyota Tsusho, or becoming doubtful on the long-term prospects, which was the case for Shimano and Makita. Overall, the turnover remained low at around 9%, meaning that more than 90% of the portfolio was unchanged when compared to the previous year. Net gearing decreased to 17%, reflecting our belief in the significant opportunities available. The most significant development of the year from the investment perspective has been the leap forward in artificial intelligence large language models such as ChatGPT. AI can be thought of as comprising multiple layers: chips, data centers, models, and applications, for example. Currently, much excitement has been about the opportunity in the first layer, chips. But as time progresses, we expect a broader view to be taken about where the opportunities are. The investment landscape remains complex and at times contradictory, but technological progress and the investment opportunities that flow from it remain a constant. We expect this technology shift to provide opportunities for many of the companies within the portfolio, including, but not limited to, SoftBank, Rakuten, CyberAgent, and GMO Internet. We're seeing more entrepreneurial founder-led businesses in Japan than ever before, and around 30% of the portfolio has a founder owner, which is more than 3 times that of the market. Over the long run, we think these businesses are more likely to act entrepreneurially in seizing new opportunities than a business run by salarymen being pushed along by short-term pressure from shareholders. We recognise that the past 2 years have been difficult for shareholders of the Japan Trust, and we hugely appreciate your support. We are sticking to an approach that has been effective over the decades of trying to buy businesses with attractive long-term growth prospects, not fiddling with the portfolio and letting those businesses generate their returns over time. This approach has never worked every year, and the past 2 years have been a particularly challenging time. However, we believe that the opportunities for growth investing in Japan are the greatest since the global financial crisis and ask for shareholders' continued support.